to the Financial Management Seminar course. I am Farah Usama, and today's lesson is titled Financial Crises. Modern history has witnessed many crises, whether economic or financial, or those resulting from natural disasters or wars. The impact of these crises and their repercussions on countries may vary depending on their size, scope, type, and time frame. We find that some crises have a limited impact for a short period and within the country itself, and others have effects that extend to include countries at the regional level and may last for several months. However, other species may infect a specific sector and then spread rapidly, with repercussions extending to a large number of countries. In this pedagogical video, we will review the most important financial crises that the world has known over the past century. But first, we will learn about the concept of financial crises, their types, and the reasons for their occurrence. The concept of a financial crisis. It is a situation that affects the stock markets and credit markets of a specific country or group of countries, and its danger lies in its effects on the economy, causing in turn an economic crisis and then an economic contraction. And the confinement of loans is usually accompanied by a cash liquidity crisis, a decrease in investment, and a state of panic and caution in the financial markets. Accordingly, a financial crisis can be defined as a state of financial turmoil or impact that exposes financial market players to liquidity problems, requiring the intervention of national authorities to contain these conditions. A financial crisis may take the form of a debt crisis, a currency crisis, or a banking crisis. Causes of the financial crisis. Economic fluctuations. When the economy faces cycles of growth and recession, investment and production activities decline during downturns, reducing demand for loans and investments, which puts pressure on the profits of companies and banks. As this recession extends, bad debts may accumulate and fear of sustainable growth increases, causing investor confidence to collapse and resulting in a decline in asset prices and escalating liquidity pressures. Inflation. Continuously rising price levels reduce the purchasing power of individuals and companies. The cost of production rises and future expectations become precarious. Central banks often respond by raising interest rates to control inflation, which increases the cost of borrowing, hinders investment, slows economic growth, and may paralyze financial markets. Debts. Increased indebtedness of governments or individuals represents a constant burden on their budgets. When debt grows faster than revenue or income, interest and installments are difficult to pay, lenders' confidence shrinks, and the interest rate on new loans rises. The rising cost of debt servicing may force governments to cut spending or impose new taxes, exacerbating the recession and creating a debt spiral from which it is difficult to emerge. Banking crises. Banks and financial institutions may invest heavily in high-risk assets or grant loans without an adequate assessment of repayment capacity. Therefore, facing significant banking sector as a whole, the crisis quickly spreads to other institutions and the entire economy. Political crises. Government instability, protests, or wars create an unfavorable environment for investment and trade. Investors flee turbulent markets in search of safer havens, exchange rates collapse, stock markets decline, and rising security and military spending costs increase government deficits and public debt rises. Unexpected events, natural disasters, earthquake, flood, hurricane, or epidemics, COVID-19, can suddenly disrupt production and services, halting supply chains and reducing demand for assets. Governments and the financial system need urgent liquidity injections and support for the health and economic sectors, which increases debt pressure and creates a financing gap. In the absence of adequate preparedness, these shocks may turn into major financial crises. Types of financial crises. The International Monetary Fund has distinguished between four main types of international financial crises, which are as follows. 1. The banking crisis is a sudden and significant increase in deposit withdrawals from commercial banks. This stems primarily from the continued decline in the quality of bank assets. When deposits are unsecured, A decline in the quality of the loan portfolio and an increase in bad loans can lead to a banking crisis. In this case, customers tend to withdraw their deposits before the crisis occurs. MER2, an exchange rate crisis, or currency crisis, is a collapse in exchange rates or depletion of exchange reserves as a result of currency speculation and exchange rate instability. In most cases, exchange rate crises correspond to banking crises. Exchange rate crises are among the most common crises in the world. From 1975 to 2007, 158 crises related to exchange rate crises occurred. 3. Financial crisis of securities. These crises occur when there is a large and sudden demand for the sale of financial assets by holders of these securities in a limited period of time and lead to significant damage to establishments and organizations, which leads to a decline in the share prices of these organizations and a decline in the market value of the assets, which leads to significant losses that may lead to their collapse. Number 4, debt crisis or external debt crisis. This crisis occurs when a country is unable to pay its external debt services, including installments and interest, declares its inability to service the debt, and enters into rescheduling negotiations. The most important financial crises. We will discuss a group of the most important financial crises that occurred in the last century. Great Depression 1929. The Great Depression is considered one of the most serious financial crises in modern history, and it began with the collapse of the U.S. stock market in October 1929 in what was known as Black Thursday. The crisis was the result of excessive speculation, weak oversight, and a massive expansion of lending without adequate collateral. This led to the collapse of thousands of banks and the bankruptcy of companies. The unemployment rate rose to about 25% in the United States, and the infection spread to the rest of the world, causing a global economic contraction that lasted nearly a full decade. This crisis has had far-reaching effects, prompting governments to undertake major reforms to the financial system and establish stricter regulations. Latin American debt crisis, 1980s. Latin American countries experienced a stifling debt crisis in the early 1980s when Mexico declared its inability to repay its foreign debt in 1982. The crisis came as a result of the accumulation of debt during the 70s due to huge loans provided by international banks at low interest rates, and then the sudden rise in interest rates in the 80s. The crisis has spread to other countries, such as Brazil and Argentina. This resulted in a sharp economic decline, and these countries were subjected to strict austerity programs under the supervision of the International Monetary Fund, which led to low living standards and widespread unemployment and poverty. Asian crisis, 1997 to 1998. The Asian financial crisis in Thailand began in 1997 when the Thai baht collapsed as a result of financial speculation and declining foreign reserves. The crisis quickly spread to other countries such as Indonesia, South Korea, and Malaysia. Local currencies and stock markets collapsed and economies entered a deep recession. The International Monetary Fund intervened with massive bailout programs, but the crisis had severe social and economic impacts, with millions of people losing their jobs and investor confidence in emerging markets collapsing for a long time. Dot-com bubble crisis, 2000 to 2002. In the late 1990s and early 2000s, financial markets witnessed a massive bubble in technology and internet companies. Investors invested heavily in startups that were not making real profits, leading to unrealistic inflation in stock prices, especially on the NASDAQ. Between 2000 and 2002, these companies collapsed and the markets lost about 75% of their value. This led to the bankruptcy of thousands of startups and huge losses for investors. But the crisis helped purify the technology market and create a more realistic environment for the subsequent emergence of major companies such as Amazon and Google. Global Financial Crisis 2008. The global financial crisis is one of the most severe economic crises after the Great Depression. It began in the United States as a result of the proliferation of high-risk mortgage loans and the innovation of complex financial products such as derivatives that concealed the true extent of risk. With the collapse of the real estate market, these assets lost their value, leading to the collapse of major banks, most notably the bankruptcy of Lehman Brothers in 2008. The crisis quickly spread to the entire world, causing a severe global recession and billions of dollars in losses. The crisis has prompted governments to adopt massive bailout plans and reform financial systems through rules such as Basel III. European debt crisis 2010 to 2015. Eurozone countries faced a sovereign debt crisis after the global crisis, especially Greece, Portugal, Ireland, and Spain. These countries suffered from huge financial deficits and the inability to pay their debts. Markets lost confidence in these economies, and borrowing costs rose dramatically. The European Union and the International Monetary Fund intervened with rescue plans, but in exchange for strict austerity measures that severely affected citizens, as unemployment and poverty rates rose and widespread social protests broke out. COVID-19 pandemic crisis 2020. With the outbreak of the COVID-19 pandemic, governments around the world have been forced to shut down economies and impose strict health restrictions, bringing economic activity to an unprecedented halt. Global supply chains collapsed, consumption and investment declined sharply, and the world entered an economic recession. Central banks and governments intervened with massive stimulus packages to support businesses and households, but this later inflated public debt levels. Despite its drawbacks, the pandemic has accelerated digital transformation in several sectors such as e-commerce, education, and remote work. Finally, it can be said that each of these crises differs in its causes, but they all highlight the fragility of the global financial system and underscore the constant need for strong financial governance, regulatory reforms, and economic diversification to protect economies from collapse. Thank you for your attention. See you next time.